pounding on the table for my team. Every night I flex, I'm making big moves.
Welcome back to Pounding the Table. We are super excited today to introduce Mr. Cem Karsan, aka Cem Karsan on Twitter, aka the Bread Man. So Cem is the founder of AEGEA Capital, which is going to be rebranding here as Kai Volatility Advisor, based out of Chicago. He's one of our favorite followers on Twitter. So super honored to have you on the show, Cem. Welcome.
Thanks for having me. Looking forward to it.
Awesome. We have a ton of great questions from our fellow pounders, but before we get into the nitty gritty, if you don't mind just quickly introducing yourself, what's your background? How did you get into the financial world and start?
Yeah, not your typical route. So I was born in London, lived in Turkey as a child, moved to Texas of all places, at the age of 5.5, 6, and went to Turkey every summer, kind of grew up across different countries and different cultures. And it really kind of gave me, I think, a different kind of view than your average person. Was really into macro policy and foreign policy. Mm-hmm. When my parents lived in Norway, I ended up going to prep school on the East Coast. So I was always kind of, into international relations and policy. But at the same time, my father was a PhD structural engineer. My mother is an engineer. I grew up, loving math, loving science. And so I didn't really know where this would all how this would come together. Applied to Georgetown School of Foreign Service, got in, a couple of other kind of foreign policy schools, but then ended up at Rice University, which was this great engineering school that also had a great policy institute. There's the James A. Baker Policy Institute. So it's like this perfect combination for me, allowed me to not commit to kind of being in policy. And then I really got into the engineering courses and into the math side of things. Was always, really into financial markets as well, and had, a stock account that I would trade starting at Andover, and started learning about derivatives, and that seemed like a natural kind of thing for me, particularly on a macro level, right?
Yeah.
And so I had this amazing, unique opportunity to go, come to Chicago and trade in the pits of Chicago in the S&P 500 index complex. And it was, a Rice grad had come and interviewed at Rice. A couple guys I knew had worked at that firm or were working at that firm. And it just was this amazing, unique opportunity to get kind of deep into the belly of the beast. Yeah. And learn firsthand. And I couldn't have, chosen a better opportunity. That was in 98, 99, right before the tech bubble burst. Mm-hmm. And, really gave me a unique, insight into kind of how the market works. And not just how it works, but really, it gave me an opportunity too, to dive in and make a lot of money, in a vol market that was really, pretty intense, during the tech bubble crash. I came in on the tail of long-term capital as well. So really got this interesting picture of how important supply and demand were, right? Most people come into capital markets thinking about fundamentals and price earnings ratios and, all kinds of other, what I think of as secondary, factors that influence the supply and demand flows. Right. But I really came, from a flows kind of background. Mm-hmm. And that really informed, the way I look at the world. I'm sure we'll talk about later kind of the Vanna-Charmer and all these other directional indicators. but all of those indicators, really came, from necessity. I managed a really big book. We were 13% of the S&P volume. Once I left my original firm and ended up becoming, a bigger market making firm on my own down there. And those positions would invariably, you'd sell what was high and buy what was low and structure these really big positions. But it really, you'd have the same position as most of the street and the dealers would, because you were taking on the flow from the customers. And, invariably those positions would lose money or not make money. And even though they were priced at a incredibly cheap or incredibly expensive level, the more you did attribution and tried to understand why that was, you began to realize that it was really the reflexivity that I talk so much about dealer positioning. And, in order to capture those edges, I knew I had to go buy stock or sell vol as that decayed. And those effects, I was not the only one. It really becomes this chase to do that. And those things ultimately affect the distributions of underlying as well as the vol dynamics as well. So again, we'll dive into that more down the road, but I don't want to get ahead of myself, but that really is kind of how I got started in the business, how kind of my view of markets kind of started, and that's kind of what informed I think what's a pretty unique kind of angle at looking at the markets.
Yeah. And for those who are like unfamiliar, right? So folks like myself and maybe many of our listeners, you kept mentioning being a market maker, right? I come from the sports betting background, were you essentially the bookie or kind of like acting as the casino? Is that what that means, market maker?
Kind of. Essentially a bookie or an insurance company or all these things do the same thing, right? Their business is to manage risk and to take edge out of the marketplace. In that sense, it's the same, right? You price insurance, you price a bet, and how do you price it? You price it based on the information that's available to you. And the information that's available is generally based on other series of bets or other probabilities that are out there in the world. And you hedge yourself based on correlated trades or things that are somehow integrally connected as a derivative or otherwise. So, as a market maker, your job is really to look at every single piece of financial information that's out there, to digest it in real time, and have each piece of information affect a broad kind of matrix, think of it, of models that three-dimensionally or five-dimensionally moves every other kind of factor and every other exposure. A lot of people are used to looking at factors of stocks, but there are many more factors than that, right? There's the skewness of a distribution. There's the different parts of the whole distribution, right? Of each equity, of each factor, right? Each ETF speaks to that, the distribution as it relates to that factor. So if you start collecting all this information from the market, you have a very good sense of where everything is relative to each other, and you can really in real time kind of buy high, sell low across different products, different strikes, different expirations, and really, extract edge in real time from the thing. But the key there is understanding the interconnection between everything and understanding the kind of the distributions of looking at it in probabilistic terms, and understanding how things are related in that kind kind of construct.
And that's your secret jelly, or jam.
Right, exactly what it is.
Gotta throw one joke in there always.
I couldn't imagine like all the information and the experiences that you learned from coming up in that time, which is, probably some of the most volatile, amazing trading to have, once you're experienced and learning all that. And I know that you're now, pretty much the authority on all things that you speak about on Twitter. And I just got to read this quote out because I love it. It's one of my favorites that I've read from you. There doesn't exist much in textbooks because it is not common knowledge. I am the authority. Everything I teach here, I taught myself and are my own theories. None of it was learned in a textbook nor taught to me. I learned all of this from 40,000 hours in the belly of the beast. And you've got to think in probabilistic terms. And I love that because I started, trading options when I was about 15, 16. And no, I did not have, that real world experience. I was just kind of going with what I can see, right? Like I can notice certain flows moving this way, or rotations between sectors and individual names and all this. But you've taken it to the extreme and then some, right? So really excited to get into all these different Greeks and understanding the nuanced ways in which they work. Because I know a lot of people are more focused, like you're saying, on these fundamentals, thinking about where the stock will be in a year or 2 years or 3 years. But a lot happens in the meantime that I'm sure, that's why you're on Twitter now, I would imagine. I know that people love your information. They constantly ask you questions. Not that we're here to clear some of that up for them.
Yeah, absolutely. I mean, the reality is, I said 40,000 hours, and then I went back and kind of did the math, and it's probably closer to 50. I'm getting old, but as we were talking about before, Tony, 50,000 hours. It's not just the time, right? If you're looking through a keyhole for 50,000 hours, you see one thing. But if you're in that belly of the beast, right? You're kind of seeing the trades happen. All of the players, they're either standing in front of you or them by name, and you're experiencing that in the pressure cooker of 2008 or 2001, and that time is expanded at a very high level. And as I mentioned at the top of this, the best ideas and the best kind of understanding comes really from necessity, right? If you're managing a really big book and you're seeing these things happening, you start looking at attribution and what's causing things, and you begin to tease out what's actually happening. And that's kind of how I fell into all of this.
I just want to ask a quick question there. Sorry, I didn't mean to cut you off, but like in terms of like being in the belly of the beast, you mentioned, these traders, these folks by name, right? And we always talk about, me and Tony, just like personalities of certain stocks. So I'd imagine you start to learn the personalities and trends of those individuals,
100%.
how they're going to be trading.
That's such a cool
what they had for lunch potentially could change, No, but like, I'd imagine, does that come into play at all?
100%.
Yeah.
So, I mean, the S&P pit is, I don't know how many it is now, but, at the time I was down there, probably 350 people on the trading floor, not to mention the hundreds of, if not thousands of big players off the floor. And so, and all the big guys have a propensity to do certain things. And they, everybody's the bigger guys in particular, I would count myself among those when I was down there. They push the markets in certain ways on purpose to try and, because, for the benefit of all the players, to get ahead of it, to push things in. And so there's who's doing what, why they're doing it, what that means, when they're done or when they're at their capacity, what that's going to mean. Part of the reason pits are still there and why they're still so valuable in products like the S&P or the Euro dollars or things that are kind of institutional, big products is you lose all of this information that we're talking about in an electronic exchange. So you get cascades, and actually worse still, there have been studies done that where execution prices are actually significantly worse for block orders in electronic markets. When you're in a market where people know who one another are, right? They're actually more likely to say, oh, this guy just has this one order. He wants to get it done. And it's a match, like we've worked together and we're going to work together again to make sure we can help each other out and get to a common price. So you get to a better place. There's this old marketplace that still works quite well when you're in a otherwise illiquid kind of market without information. So in a way, more information actually creates better, understanding of what's going on in the market and more stability, and better execution prices. So, that's the reason those pits are still there. I think they'll be around for a long time. Obviously for retail, better to, electronics better. It's anonymous. It's, but there's to your point, there is a ton of information that's gained, also to market makers' benefit. A phone gets picked up, who the broker is who's picking up, who's likely to be on the other line. The algos of these market makers right now, a certain line rings, a certain broker picks it up at a certain time of the day. That's automatically a buy signal for certain algos, in certain strikes in certain areas. And, I know that as also I'm being on both sides, as a customer, I now call down there, and I have to be super cognizant of, who I'm calling, when I'm calling,
right. Wow.
Like all these little details. And, so it's a big, there's a ton of information, big game, and a lot of participants.
Everyone's trying to process all that info as fast as they can in as many places and as many people. I mean, the thing about liquidity is so true, right? Like if it's just like you and me in a market, it's whatever we pay, and I can, jack the bid up and you can sell it to me higher or whatever, but then you have the liquidity, then, there's more money at play. There's more pieces to consider, right? So that's why it's so important, I guess, to include all those things. And this actually brings us greatly to our next point here about you calling that move, Vanna coming back from the beach, March 31st into April 1st. I mean, that was one of the most amazing moves I've ever seen. I remember I think it was the 39.50s went from less than $1, or might have been 5 cents, I think, to 30 or so. And it was one of the most incredible end of day rips I've ever seen. Maybe that way you can talk about, the theories, logic, the genius behind, the gamma volatility curve, Vanna-Charmer, Gary, dispersion, fixed strike vol, whatever you want to get into, the table is yours.
Yeah. Who are these guys? We got to know.
Well, look, the important parts are vol supply, right? It always starts with vol supply. We call him Gary. There's, I won't go into the whole story, but essentially,
mysterious,
Yeah. essentially you go find on dealer, look up, on Twitter, you just look up dealer, positioning of Gary, and you'll see a description. But basically what it is, if market makers or dealers or people warehousing risk are overwhelmingly long volatility, it makes it really hard for the underlying market to break down, because volatility is a hedge, and ultimately the natural flow of things over time is higher, because positive flows from both these other factors like Vanna-Charmer, as well as just natural people make money, the economy generates earnings, and there's buying pressure. So you start with Gary, and you start with this understanding of volatility supply, and then you add on top of it that understanding that if volatility is oversupplied and it's going to decline or at least decay on a daily basis, that means you have natural positive flows coming from things like Vanna and Charm. Charm particularly is, per time, very predictable. If time goes forward, if volatility doesn't, go crazy, right, because it's oversupplied, you're going to get this daily buying back of deltas versus a kind of short put, long call exposure. So the world is short put, long call on the dealer side because people are hedging long put, out of the money, short call to hedge the long exposure. If you're alive, you eat, sleep, breathe, you're long the market. You have a house, you have a job, you depend on other people having jobs or buying your goods or listening to you on a podcast. And ultimately we're all long. So the insurance premium, the risk premium for being long is ultimately downside protection, is where the insurance risk premium is. And the oversupply is going to be on the selling calls against your position to kind of generate yield. And so in the equities, at least, there's one-sided skew. It's the highest skew in the world in the S&Ps consistently, because this is where people come to hedge. And and what that tells you is that the S&P complex is dealers are always short put, long call. And they'll do it in a massive way. And it's actually, they don't mind being long, short put, long call, because it's a great trade. In the long term, you have to manage the risk on it. It has a real tail, as we saw in March, right? But the reality is you're selling the carry trade. You're selling a high vol and you're buying a really low vol and you're hedging them and you have a structured edge. But to capture that structured edge, you need to buy back the short stock or the linear hedges or whatever other hedges you have against it every day that goes by, because that skew is going to decay. That skew goes to zero over time. And so if that skew decays to zero over time and there's a constant buyback of stock and Gary's there, and everything's offered, the market is going to go higher as long as it doesn't break out of this oversupply status. And so, the buying of Charm, and again, Vanna relates to this in terms of both contango, right? And the decay there. Vol, but also in the sense that if you're sitting there over time and things are decaying, vol generally is going to continue to decline, right? So Vanna comes into it that way and exacerbates those flows and makes them even greater. But the flows are not linear, right? They don't happen equally over time. They happen over expiration cycles, and not only over expiration cycles, like in general cycles, they're really exponential, right? They really ramp into expiration because decay of options and skew is exponential, right? It decays more as you approach, significantly more approach expiration. And so, understanding of these expiration cycles, understanding of these Vanna and Charm flows and the vol supply and how they interact, like I'm speaking about, really informs a major, I would say, I like it's about 40% attribution by models, which is massive if you think about all the flows in the market.
It's a lot.
And that's just on average. So during the really high times, it's way more, and during the low times, it's less. So understanding those flows and how they're coming and how overwhelming they can be in the face of all these other factors. Everybody's thinking about fundamentals or risk parity flows or rates and how that's affecting kind of all targeting. But the reality is this is a major piece that people just miss. They don't fully get or understand. And it's actually honestly something that, that's not, like I said, it's not broadly understood because, there are very few people who have experience, that I and a lot of other market makers have. And even those that have had it have had very little experience translating that to market directionals because you're either a vol trader, you live in your kind of vol neutral, market neutral vol world and manage the risk on those and try to digest that, or you're a equity directional trader. There are very few overlaps. And I think I'm one of those people that have really made that leap as, becoming an asset manager in the vol space. And so anyway, so that's the first kind of step into kind of that world for you guys. So how did I call that? I really deeply understanding and measuring the positioning and how big it is relative to volume, understanding the other factors. Again, this is 30, 40%, of the factors. You also have to try to understand at least 20, 30% of the rest to get the calls right with the accuracy that I've been able to. And I think a lot of those things, I fill in with understanding those other flows I just mentioned, like risk parity, vol targeting, et cetera. Understanding the timing of other calendar flows, not just seasonality and stuff, but really understanding, end of month, beginning of month flows, how big they're going to be.
20-day cycle.
Right. And understanding then the technicals, the 20-day moving average, and understanding the parts that you don't know, let's say that 20, 30, 40%, depending on the scenario that you don't know. Again, if you're looking at a puzzle and you only have certain pieces of that puzzle, you don't have the whole picture, but you have a sense of what's going on. You need other things to give you clues on the other pieces. And that's really how I use technicals. Like the 20-day, critically important because of that monthly options expiration cycle and those calendar kind of monthly reporting of asset managers and the flows that come out of those as well. And so understanding kind of strength relative to that 20-day halving factors helps us, gives us clues and information about what we don't know, and really helps fill in that picture at a much higher level of accuracy.
For all of our friends that, maybe get a little lost right here, you're going to be making a children's book, right? With
I thought that was part of this whole deal. I do the podcast, you guys can turn it into kids.
Yeah, we'll make that.
We're working on it right now. It's super interesting. I mean, one of the coolest things that I think out of all the cool things you just said there is that you're combining the things that I think people choose not to a lot of the time, especially on FinTwit, right? We're getting into those valuations, the fundamentals, the thoughts of where is this company going to be in 5, 10, 20, 30 years, whatever it may be. And it's that day to day is a lot faster because the people who are really making moves and causing the flows and the big money has that monthly cycle to live by, right? That's that 20-day, like they are, and that's why a huge part of, what's going on with March, there was that end of quarter of expiration, that OPEX that came right before, all of that had to do with this. And I think, those are the things that really underpin the market more than all those other things, right? Because if you think about the market as like the tool, how sharp's the tool, right? And then you can see whatever trees come in, you can hedge them perfectly. But I love the fact that you're considering, like we always say, we're trading and investors, right? So invaders, and you kind of are doing that by looking at these different, technical analysis factor, these different Greek flows and what that tells you and your experience. So love the combination there, because I think that's really the best way to get a handle on the market, especially in times like these.
Yeah, it's a big machine is the way I look at it, right? And there's ultimately a market is buyers and sellers. And, even over the long term, it's buyers and sellers. The question is, how do fundamentals relate to the buyers? Like, how does that translate to buying and selling? And that's, in my mind, the only way that fundamentals matter, right, is how they affect buying and selling in the long term. And in a period of essentially infinite liquidity, which is what we've been in now for a significant period of time. Those fundamentals are minuscule, generate minuscule flows ultimately. And so they're essentially irrelevant in the short term. Now, there could in theory be infinite liquidity for ever, right? And fundamentals may never matter again. Unlikely, right? My point is that fundamentals matter ultimately and will ultimately matter when liquidity dries up.
Right.
And fundamentals ultimately are cash flows that a company themselves can generate for themselves. So they're not dependent on the outside world for liquidity. And so those earnings will matter when there is not enough liquidity for everybody else. That's the way I look at it. And that's ultimately how, if you look over history, how things revert to fundamental valuations. Usually they overshoot, but it's generally in times of illiquidity that and that's what we call bubble bursting or whatever, right? But it's ultimately liquidity drying up and forcing companies to fend for themselves and to create their own liquidity, which ultimately is earnings. And so I always take this, when I look at the machine, I'm thinking, what flows are this generating? And from the top, the only major fundamentals that matters is, for fundamentals is monetary. That's why it's don't fight the Fed, right? And that's why that's been the rally call for the last 30 years, because the Fed has been everything in terms of the funnel and the pipes for where the liquidity comes from.
Right. The printer goes further.
Totally. And why I was so early to call this massive rotation that we're beginning to see between value and growth, or at least DCF names ultimately, which is what I think it'll be, not value in the traditional sense, versus like these kind of duration kind of speculative names. The way we basically called that starting in August, well before anybody else was kind of thinking about this, is, again, that's a flow story, right? The introduction of the Treasury and fiscal policy as the major driver, as opposed
to major flows.
That's ultimately the one thing that's fundamental, quote unquote. That's really a flow. That's a straight flow that goes straight into the market, either from entering people's pockets and then buying stocks, as we've seen with it was relatively easy to also predict, like kind of this crazy speculative fervor in stocks. People are at home, they're getting massive checks in the mail. Right. They're not spending money. Their balances are going up, and so those flows are going to be different than high net worth people investing in passive products, right? Or corporations buying other companies and So my point is flows.
Right.
Who's buying? Who's selling? Where's the money coming from?
Yeah.
And that's ultimately what matters. That's what makes the machine work. That's the lifeblood of the system. That's what a market is, buyers and sellers. And so I think it's crazy in my mind that 90% of the world talks about fundamentals and valuations when all of that is ultimately a potential driver. It's one that matters to some extent at sometimes, right? If the time is right. And so anyway, a lot of people are going to turn the podcast off right here. Like this guy.
He hates fundamentals. I'll relate it. I'll relate it right now for them. The one thing, like you were kind of you were pretty much talking about how like it's about the chapter of that stock, like the buyers and sellers in that period of time are the ones who are still the players, and that's what matters, right? So every time I go and look at my technical analysis charts, like I'll do some anchored volume weighted average price from those events where new flows start, right? It's pretty easy to see, like if you do stuff from a couple of days after the March bottom or right around there, you can see that a lot of things have reverted back to that volume average because that's a new set of buyers from those flows. And also, I'm sure it changes nuance every single time, whether it's, the Fed put more money on this month or this month, right? But it's more about those chapters of not just the market, but, the individual names themselves and kind of seeing where they are in that chapter, right? Like I always like to trim positions when they're way extended over their volume profiles or their volume bases and such from the beginning of that chapter. So I would imagine it's kind of like a similar thought here, right? Eventually, things get overdone in one way or overdone in another, and you end up having that opportunity like we saw at the end of March. And now, now we'll talk about that soon, what you see coming, but it's very cool.
Yeah. Ultimately, this is why things continue to get to always a crazier level or a crazier extreme than people could ever imagine. And it's ultimately things are not tethered to any type of, fundamental or firm metric. It's really, it's ultimately like, are there more buyers or more sellers?
So sometimes,
and why are there more buyers? And if there are more buyers, you get, how do you explain Tesla, right? How do you explain some of these things? And a lot of these names, the crazy thing is a lot of them, because of this liquidity, this is how it translates to, monetary policy has driven free liquidity, generated massive new technologies. Tesla never would have been able to create a lot of the things they've created if they weren't provided, almost $1 trillion and, or whatever, a massive market cap and same is true for Amazon. Amazon probably would never have been able to take over in the way they did if they weren't allowed to not make profits for almost 2 decades, right? And that's essentially a funding of investment through liquidity. So we've had an industrial revolution, probably the biggest of all times. Honestly, I think when you look back, people will recognize the last 30 years as supply side driven and monetary policy driven. Technological boom. That's all.
I agree.
Right. There you go. So, but But that said, that doesn't mean it's a self-fulfilling prophecy. That liquidity goes away. These stocks, until they get to that scale, they disappear. And the ones that don't have enough earnings to support themselves, ultimately, you get creative destruction. And so, anyway, we could go on and on about this, but you get the idea here. It's ultimately all about liquidity. And there's an interesting, the switch to fiscal is really going to change that. It has already started to, and I think there's some big macro effects that I see coming in the next decade as a function of the problem with inequality that's been, that's being addressed, by through fiscal policy and what that will mean for inflation and interest rates and liquidity ultimately.
Right. And I was just going to say earlier, just like, you talk kind of big picture about these flows, and it's not just like everyone kind of gets so caught up in the details of everything, but it, you simplified it, in the sense using many other words previously got a little complicated, but at the end of the day, you're saying, it's really about the flows. So like thinking about, you've had some great predictions kind of in the past, I guess, but like some of these macro threats, thinking about moving forward, looking at the calendar, what catalysts perhaps could be coming up for the overall market, right? For specific sectors. We've seen these, I'm more of the amateur kind of retail investor here, but I just saw from January we had huge growth stocks take over. Then we saw the FANGs kind of make moves back here. So what sort of catalysts do you perhaps see coming up, or trends that moving forward that you're taking a look at?
Yeah, I'm going to sound like I'm kind of repeating myself a little bit here, but I mean, I think we've entered regime change. I called for it in August or July, August. We've had a secularly declining interest rates for 40 years. That was again on the back of we had really high interest rates and high inflation and taking us off the gold standard, Nixon doing it, and then also ultimately going with monetary policy as a driving force to drive as the reserve currency. We were able to do that. Again, through supply side economics, we were essentially able to force a ton of money into the top 1%, top 0.1% in corporations over 40 years without any real growth in median earnings. And so we were able to do it without generating any inflation. And that's the key. The Federal Reserve is they definitely understand this. The average person doesn't. But when you fund money, you send money all to capital and not to labor, that money doesn't get spent on goods, so it doesn't create inflation. And it actually does the opposite. It creates deflation because you're giving it to corporations. Corporations compete to create more efficient technology, globalization. They send, they go to the cheapest labor sources, and ultimately, cheap interest rates also make capital itself cheaper. So they don't, so everything becomes actually deflationary, and it's a cycle as well, where it accelerates. So we've had this thing where interest rates could go lower and lower because it doesn't create, we're creating deflation, but we can then fund this kind of revolutionary kind of boom in technology. We got to the lower bound. And over 40 years, well, the one cost of all this and the one kind of fly in the ointment is, even though everybody's kind of improving, the top is improving so much more over 40 years.
Yeah, it's exponential.
That people naturally are, it's not about how am I doing, it's how am I doing relative to others. And it's just the fairness impulse, in the last decade has been, people have been pounding the table about, inequality, and the zeitgeist has changed and people have had enough. And, Trump came in and he took advantage of it, just like a lot of other, just as the Democrats always have, right? Like, this is not a political thing. Just,
it's the market.
The market is ultimately saying, hey, people are saying, what about me? And so politicians are going to, gonna take advantage of that and start addressing inequality, which is what people are demanding. And as they have, which is what fiscal policy is, the move from fiscal and demand side economics from supply, you now enter back into the old world pre-monetary policy of, funding from the treasury and money going to people. And that is inflationary, not asset price inflationary, which is what we've had, right? But goods inflationary.
That's
the one thing that the Federal Reserve in a box. So to answer your question, Avi, I'm going about it in a roundabout way, is, this is regime change.
Yeah.
And people, once they start getting the checks, or once we have infrastructure spending, or once we have, better healthcare, or, the list goes, better education, all these things have actually positive multipliers and actually do generate real growth. We have anti-globalization, so people get paid more, and all these things lead to higher rates, and they actually lead to less liquidity, equity market liquidity, which means companies have to generate their own earnings, and it's this whole move away from growth names at all costs, give them free money. As long as it's a good idea, they're getting more eyeballs, they'll eventually grow into it and create a great product, and it's a great investment. That you can't do that anymore. And it ultimately is, hey, how much dividends are you giving me, or how much, actual growth, cash flow are you going to generate? And so my answer to you is, that's the regime change. Rates are going higher. We've already seen the beginning of it. It's a secular trend, in my opinion, at least for the next 8 to 10 years. Usually these cycles, historically, this is not the first time we've gone through this. It's bigger. It's more kind of significant maybe than some past, in recent history. But usually these are closer to a decade of a reset, maybe 20 years. But their equity performance multiples generally are hurt quite bad on this, right? If you take money from the rich and you give it to the you're going to get multiple compression. There's less money to go around, less flows to buy stocks, because there's more money going to buying goods. And so it creates multiple contraction, but earnings improvement. During the 70s, we had significant earnings growth. GDP growth was actually quite good, even relative to inflation. But markets did nothing for a decade. In real terms, they went down significantly. And so, that's, the economy is not the market. The economy is going to do quite well. I say that a lot on Twitter. People, scratch their head and don't get it. It's actually it tends to be counter correlated.
Right.
The more better the economy does, the more odds there is for inflation. And the more odds there are for inflation or higher rates. The poorer the liquidity is, the less, the more multiple contraction you get. So that's the macro picture. Again, that's not all, that's only part of what I do. Most of my stuff is the other more detailed, machine, inner workings of the machine flows. But I don't think you can do all of it well unless you have a good understanding of the pipe, the big pipes flowing, from the water treatment plant to begin with. So,
I like that you distinguish between, like where the money's flowing to. It's like, it's still out there. It's just not as much asset inflationary. It's more, the actual goods that are underpinning the economy. So we've been, agreeing with you for a long time about the economy is going to be booming and doing very well. Like that pent up demand has been here for quite some time. I remember even in last May, I believe there was a cruise ship article that said there was a 44% net increase in bookings from 2019 to 2021. And from that article, I was gun-ho bullish. I knew that things would broaden out and cycle together, and it was off of one random website. And then I started looking at a couple other, and, that's like information, it's important stuff to know what people are wanting to do. So I think that's very cool to think. And this value compression thing, it's a hard initial shock. And I think that a lot of those companies who have value, who are worth, what they are now, I think they'll do well over the long term, of course. And a lot of those companies who are coming through, LMAO, SPAC, or whatever it may be, are going to probably have some more trouble in the future. And knowing that we're going to have some of this movement and rotation over the next few years, pretty interesting to know. Would like to know what you think about, predicting those SPX levels, what to watch for. Like maybe not as much. I'm not sure if this person was asking more so technically or, just the non-technical factors you've been kind of mentioning more so about. But, how do you get those SPX levels that have 10 to the dot every day on Twitter? What are you calling Jerome and what's going on?
There's certain things I can't tell everybody, right? Everybody wants the golden goose. I gotta keep him in his pen.
We had 10 people ask that same question.
Yeah. But I can tell you, it's just like my other kind of predictive things. It's a mixture of several factors, and one of them is gamma supply, right, in the SPX and outside. But it's also a understanding of technical levels and, an understanding of broadly flows and where they're likely in a general area to give out. And when they do, whether on the downside or upside, where Gary is in control and where they're likely to kind of be pinned. So, there's this extensive process there, but it does start with understanding kind of gamma supply, and understanding technicals and important levels, based on, as it relates to flows. But, I've said this before on Twitter, we have a 27 factor model. I mean, there's a lot of little things in there. Some of them are very traditional, like momentum and mean reversion, right? Like you gotta start there. And then there's, others like put call ratios and, sentiment factors.
I was going to ask if you use the put call ratio often, but cool.
Yeah, I use put call equity a decent amount for very short term. Kind of, if I'm watching something and I'm waiting for it to happen and I know it's happening, that's probably my shortest term kind of trigger for sentiment. So when that ticks down to a certain area, given a certain set of other things, that's an important factor that allows me to call the turn better and to time the turn better. But yeah, again, that's one of 27. So, there's
so you got to know the whole pie. You got to know all the ingredients to bake the pie. Yeah,
that's right. That's exactly right. The croissant recipe is buttery and delicious, but you have to have all 27 ingredients. Otherwise,
That's amazing. So do you also use that, the fear greed index that everyone on Twitter is nonstop, like that? I see that all the time. When things get euphoric, you see that 96 out of 100 and things are depressing. It's like 30, we got to turn soon. What do you think about that? How does that work? Does that get factored into you at all?
Sentiment is important, right? Any trader that tells you it's not important doesn't understand.
I'm a sentiment trader. I fully believe.
So but there's different kinds of sentiment and different kinds of sentiment work over different periods of time. There are different types of traders, and they matter more during different parts of the buying process. And so understanding what sentiment applies to what flows, again, it all comes down to flows and kind of relating those into your factor. Yeah, you gotta, those things ultimately inform kind of the model in that regard. But all of my, if I have 27 factors and some are very, there's a couple that are very long cycle, right? They move very slowly and they matter over the course of a year.
Right.
And then there's some that move over the course of minutes. So, you really have to have these, overlaid models of long, mid, short, micro, that really build off one another and give you the full kind of context.
So just to piggyback on that sentiment, right? So just recently, this Johnson & Johnson news came out that 6 people had unfortunately, of course, passed away from the shot from the Johnson & Johnson. And you view that, 6 people, that's alarming. It's over every single headline. And then you see how many people got it. It's like 6 or 7 million people, right? So on one hand, you could say, oh my God, that's, the whole world, these vaccines don't work. They're very, very scary. On the other hand, you can say, okay, it's 6 out of 6 million people. And if you do the data there, so my question is, I guess, how do you parse through the news in terms of taking away the headlines that may scare off, a lot of retail investors, where in reality, people aside, just looking at numbers, unfortunately in the situation, but you know what I'm saying? How do you start to parse through some of that and understand what's real, what's not?
So obviously I'm going to sound like a broken record here. And this is what I think hopefully what your listeners most get out of this is that, it's easy to get distracted by all this information. And the key to doing this right is parsing out what's important and getting rid of all the noise. And if anything, taking advantage of the noise, knowing, hey, that's not important. Like the people fade that all day long. So
and you can profit from the counter move on that.
Exactly. So, I'm going to sound like a broken record, but my question back to you is, how does that affect flows? Now, I'm not saying it doesn't, but that's the real question. Right. That's how I would process that. How do I process that? How does that affect flows? That's always my question. Okay.
It's all going through that lens.
It's all going through that lens. So, I'll walk you through that example. The way that can potentially affect flows is Bullard has come out recently being very clear, saying the Federal Reserve will not raise interest rates until we get
75%.
75%, exactly, herd immunity. Okay. So they've been very clear, like, this is, monetary policy is dependent on us getting to that number. That's how that matters to me. Okay.
Outcome based.
Yeah.
Right. And that's so interesting because I thought the same thing here. And so just to piggyback one more time off of this, because I was having this conversation literally today, about this. So knowing that the Johnson & Johnson vaccine and all these other vaccines, right, you need to get that 75% to herd immunity, factoring in all the people who don't want to get it. And I doubt it's going to get mandated. You absolutely have to get it for everyone. But regardless, that at first Bullard was saying mid 2024, and now it's kind of switching a little more to this outcome-based thing, even though it has been, but they dialed back the time. Right now they're saying we think it's very unlikely that we raise before 2022, right? So the narrative's kind of flipping a little bit there. We had 2024, mid 2024, we were sailing Vanna, we're partying at the beach for years.
Right.
And now it's okay, guys, it's just kind of coming soon. And we'll probably do some QE tapering before, and then we'll taper some more. And so it's looking like the narrative's flipping in that way.
Right. And I mean, if you ask me, in June, July, August, right, I would have said, we're going to be at herd immunity, probably by July or August of this year. And I still think that's the case. I don't think Johnson & Johnson, at least in the US, right, maybe not globally, but,
right.
And so I still think that's the case. I don't think these, Johnson & Johnson getting paused is going to make a dramatic difference. I think we have all the resources of the world.
Right.
Everyone is being dedicated at all costs to the production of this stuff. And there are going to be bumps and fears and concerns along the way. But the trajectory, we're talking a month longer, a month shorter, something big could happen, a variant that's not going to be, that's not going to be covered by, at least, fully by the vaccine. But again, I've done my research on that. I understand what the odds of that are. It's very low. My wife's a pulmonary critical care physician. I grilled her from the very beginning. I've done my research. I know the probabilities are incredibly low, even if it's not as efficacious. You have to understand that the flu vaccine is less than 50%.
37,
right?
Exactly.
37.
Yeah. So we're talking about vaccines that are broadly available that are 95+%. Even if against these other strains, if it's 50%, you're still fine. You're not in a situation where you were, right? You're having to deal with small fires here and there, but we're going to get back to normal. And I think that's the important part. And so, don't get distracted by the shiny objects, right? Understand if it's something that really can alter in a significant way the trajectory of where we're going, and otherwise stick to the plan, stick to the understanding of the flows, understand how is that changing things. Would be my answer. So
So piggybacking off of that, just kind of going back to what you were previously saying, where you're thinking June, July timeframe roughly. Is when we should hit that capacity, that the herd immunity, right? So would it be fair to say then, you think that for the next couple of months, we're going to continue to do well from the stock market perspective as a whole. And then when the economy, it starts to pick up again and things start to look better, if in most people's mind, from a Corona perspective, that's when you think that things will start to shift a little bit back?
Yeah, I think here, and I've kind of said this publicly on Twitter, I think in the short term, and I've called for this again since August of last year, the spring is important. Getting through, there's a reason all these seasonality factors exist. We, especially this year, coming out of, a really tough COVID winter, right? It made sense and the fiscal response that would be paired with that I, saw coming, it made sense to get this push, especially in the spring. Now the housing market's hot, again, not a surprise. And there's a ton of positive flows. People are buying goods. People have more money in their pockets. They haven't been spending. They're going out and they're getting spending. So, and there's more money flowing in. That said, it's this is pushing rates higher. We've been seeing rates climbing for a while now. I mean, there's been a little bit of a short term this week kind of stabilization, but
finally,
finally, right after like eight, 9 consistent weeks in a row of increases and yields. So I think that continues. This is a brief kind of digestion period for rates, but we're getting earnings now. They're going to come out stellar. We're already starting to see that.
Yeah.
You're likely to get an infrastructure spending plan sometime soon, or at least the insight that it's coming, right? That people buy in fully that it's here. And then next month, you got taxes due. Remember, everybody, retail, mom and pop bought stocks in March. Everybody, they were given a bunch of money on the bottom. Market was down 35%. People were underinvested. People bought. People made a lot of money. They're going to have to pay taxes on that. And people, haven't been making estimated payments. Trust me, there is some selling that's going to happen based on that. There's also this window where a year past when people bought. So it's going from short-term capital gains. Nobody wants to realize those short-term capital gains, but once it becomes long-term anyway, like, okay, I got to take some profits. I got to sell,
Right.
So there's a natural selling pressure coming here in the next month. And that's part of what's allowed me to say, okay, we're probably going to top out short-term in this 41-40 area, like predicting the dates and the cycles. And this is a reason why I had some short-term confidence that, again, we can go a little higher than this. It wouldn't shock me, but in the short term, at least the next 2 weeks, it's a risky period because all these factors are sitting out there on the other side of this. If we stabilize the next 2 weeks, I could see us kind of grinding higher for another month or two, but I would be very, very cautious, in the months to come. I think most of the story has played out. Earnings are likely to pick up. And again, that response to earnings is ultimately more inflation. I think the spending response is just starting. I think we're going to have if infrastructure passes, we're going to have an avalanche of different, spending and earnings growth. And, I'm seeing it here in Chicago, which we haven't seen a hot real estate market, throughout 2007, 2008, even before, since 2007, 2008, we haven't had, any real estate appreciation here. And in the last year, we've seen about 25%, just in the last year. And that's not just lack of supply. That's a big part of it. But the demand of, individuals buying their first single family home. I mean, there's massive under ownership because the millennial generation had 2 financial crises, growing, debt, from education and all kinds of other things. And that's being solved ironically by this fiscal, stimulus. And so, housing is a huge driver. A lot of other, earnings, consumption growth, is huge. And so ultimately we're going to again, watch those rates. And then if we start seeing Gary get unpinned, that's it. We can move back into kind of the Greeks here. Yeah. As we rally, fixed rate vol, which is basically, if you look at an option smile, there you have skew. So downside vol is priced at higher than upside. And so we naturally slide to lower vols. If we continue to rally here, we're going to continue to slide, and vols continue to come down. On top of that, we're going to slide to a floor. And we're already getting there. We're already very close, in my opinion. And ultimately, what that will do is create more and more buyers of vol protection as we rally to new highs. And that should, over time, here in the next month or two, in my opinion, especially once Vanna is pulled out, she's on vacation, Charm goes on vacation. It's likely to remove some of the oversupply of vol with the expiration of the April monthly here. And my view is that as vol goes, Gary becomes hungrier. There's less, of all their rates go higher, which also removes liquidity, which also feeds gamma less. You're likely to get not only multiple contraction, but you have this potential energy for a real expansion in vol, which we haven't seen in a while. And so, there's every reason to believe that, Gary, which has been kind of the linchpin for holding this whole thing together, this over gamma supply is into a rally, is going to remove all the excess kind of gamma and protection that's been holding things together, and which will shake things out a bit. So again, is it the end? Is it the end of the rally? Are we going to collapse? No, this thing happens over time, but I expect some type of correction, which we haven't seen in a while, or maybe more, maybe even 20%, something real. At least a big warning shot, I would call it. Yes, I do, and ultimately this thing will probably go even higher, and we'll see that an even greater, result. But I think the trend is again towards fiscal, towards higher rates, and that will ultimately sometime, maybe it's September this year, maybe it's a little bit later, maybe it's March in the spring of next year, when it really gets to the point where rates are no longer, in this, you can no longer get a mortgage for 2 and 8. Now
yeah, right.
At 3.8, or 4, plus, this economy has big problems, and not just the economy. The economy actually will be fine, but this market has
what we're doing.
The liquidity will be a major, begin to become a real concern, and the Federal Reserve, the Fed can't keep. People are like, well, the Fed will just, when we decline, the Fed will just do yield curve control. They'll keep the longer end down, and the argument against that is ultimately, if you have real inflation, if you have 3.5% inflation, you start getting something real, and you try and keep the long end of the curve at 2.5%. In real terms, you're just going to stoke inflation. You're basically, people will leverage 2.5 all day long to buy things yielding 4%.
Yeah, they're just arbitraging at that point.
Yeah, and that'll just drive inflation even higher because and that long end of the curve, like the Fed will lose complete control of it. So they can, they ultimately can, and that's going to create rising rates, not just in terms of inflation, but in terms of Federal Reserve liquidity. So.
Very interesting. And like since the beginning of the podcast, we've been saying, everything's good until it's not, right? Like as soon as a taper tantrum comes in any form, right? It's a lot of, and this is, I guess, going back to sentiment a little bit. We knew that it was our foot's all the way down the pedal for the last while. Now, things have been changing over the last 2 months now. And it's very important to know and be cognizant of these things. So going back into some of those, those Greeks that you're so dearly in love with, and you always post these great photos on Twitter, the GIFs that go with them, the little emojis. Which one would you say is the most important one you want to tell the people about? Or if you want to maybe describe Vanna a little bit more, maybe Charm, whatever you can say. I know that you're pretty much in the CIA. We can only ask you, half a question. But
we got to ask for Chris Forsyth.
I'll do a little promotion here. We're going to be writing I'm in the process of writing a white paper about Charm and Vanna and how they all kind of interact and how they're important to broad market structure, right? There's nothing really out there that discusses it, and we're obviously the authority on that. So really want to put that out there to educate the world in a more kind of clear and concise way. I will give you kind of a teaser on that. And ultimately, I think we talked about this a little bit offline, but, Charm and Vanna, they're very important in how they interact for market structure. And so, Charm is the one thing that's predictable, right? That time is going to pass. It may not be linear, right? Certain events may occupy more time in terms of the decay of all, but ultimately, time does progress. And as time progresses, this skew carry trade, risk premium trade, which again, it's not just the options, it's everything that feeds into the option market as well. It does decay. And so you start with Charm, but the second you think about Charm, the term structure is broadly in contango, right? So over time, options also slide down, the term structure. So that's Vanna, right? Like the vols are declining as Charm is passing. So that's first level of Vanna, but there's two actually other levels of Vanna, which are very important, which feedback. The more you sit, because Gary is oversupplied, and the more, buying pressure there is from Charm and this contango Vanna, the more support there is, the more likely this market is less likely it is to decline, which means the whole curve tends to, during these periods, also decline altogether. That's another level of Vanna. So it's a kind of you have not only these Charm flows, you have these contango Vanna flows, and then you got broad Vanna flows on top of that, because the whole curve tends to decline during these periods. And then you have this last Vanna, which is really as you sit there and this thing decays and things come down, structurally that creates more and more vol selling because people are getting oversupplied more and more. Gary's getting more and more fed because Vanna-Charmer are supporting the market. There's more and more Vanna. And it's a circular thing where the whole curve doesn't just decline because of realized volatility declining. Supply and demand basis, vol just gets massively oversupplied and just compresses. So it's such a circular, and they're all interrelated to one another. It declines and declines and declines until it's a bottom, and then it all unwinds the opposite way. And so, the key is understanding that in 95% of scenarios, there's a natural propensity for the market to grind higher because of these flows. And there's a natural propensity, regardless of what's actually happening in the world, for vol to compress and compress and compress and compress and compress and compress from a higher level. It just happens naturally because of these supporting flows. These flows are so supportive. They're structurally supportive. They support the whole market, and they lead to, overextended market moves. They lead to overselling of vol and cycles of massive compression of vol. And then they ultimately get to a point where, it gets so oversupplied, and there are external factors that are important, like I talked about, like rates is the biggest one, right? Liquidity factors that ultimately can pry this loose. And when you hit a point like that, or it's gone to such an extreme and it gets pried loose, that's when things kind of unwind the other way. And that's what we see in March and during liquidity crises, et cetera. But this is how markets work. This is the machine. And so, the important thing is so many people talk about gamma, and there's been this kind of, people have become enamored with this idea of gamma.
It's the Tesla GameStop idea.
And there are all these services that have been about GEX, right? About like, spot, and it's valuable. I'm not calling anybody out or saying, you're doing it wrong. But gamma has been what everybody talks about. It's because, they think about kind of the explosive force of something big happening, right? And it's fun, it's stuff, sexy, right? And it's exciting.
Gamma ray, the hobby indicator.
right. But the reality is, and the part that I've really tried to kind of bring to FinTwit and broadly, the financial world here that nobody understands or talks about, is how that's actually only important, for the broad market. Single stocks, like another story, but for the broad market, it's only important in 5%, 1 or 2%, sub 5% of situations. And 95% of the time, it's the structural flows of the decay of the carry trade and what that means for broad market structure that matters. And there's so much more money to be made on that. So many more lessons, understanding of prediction and what's going to happen that come from that. You need to be able, gamma is important in terms of broad market, in terms of risk management, right? It's the tail. But the tail is like, it's a fat tail, and you need to be worried about it, but it's still the tail. The majority of the distribution and the factors the options and how they affect that distribution are via Vanna and Charm and these factors that I'm talking about. So, and it's amazing to me that, obviously I didn't know it. I didn't teach myself, but it is amazing to me how important it is when you begin to look. It's like you're looking at the matrix. You understand how everything works all of a sudden. The more you start to understand it. And I've really, been preaching about that. But I think it's important to know that this isn't something that's in the textbook. It's not something that's been written about. And that's part of why we're going to put this white paper together.
Right.
But it is something that should be in the, universally in the public sphere and well known and documented and researched. And I think we're on the front end of,
by no one other than the authority, of course.
Right.
Yeah.
When can we expect this white paper? Not to put you on the spot.
I really want to read it.
So this is an important topic. We don't want to put it out there before it's ready. But that said, we're working on it, and I would say within 3 months. But I'm gonna under promise and over deliver, hopefully. But hopefully a lot sooner than that.
So thanks so much, Cem, for coming on. Hopefully in a few months, when things start to straighten out, hopefully with Corona, maybe we'll come to Chicago, have a beer with Vanna, Charm, everyone. So thanks.
We'd love to have you out with, hopefully we can do this again sometime, on the other end of kind of this this interest rate rise, and we can talk about that.
Oh yeah, it'd be interesting to go to the before and after. It'd be fantastic to talk about. Yeah, thanks so much for coming on. I like love learning anything about options and the structure of the markets. Like I always love to think that there's so much more going on than just the stuff that we float through on Twitter, and it's the truth. And we heard it from you yourself. So thanks so much for coming on this week.
My pleasure, guys. Thanks for having me.
Pounding on the table for my team. Every night I flex. I'm making big